All right, so first we'll start with the review. By the way, I'm happy all of you back. I thought I would lose half of you after the first class, so this is good stuff. It's a good sign we're doing something right. So let's start with the review. First of all, we talked about during the first class a bit of a background about taxes. Those of you who missed the first class, there are a few of you who came up. Make sure you take detailed notes from someone in class because I spent a lot of time on housekeeping stuff. You know, these are the elements that will help you do well in the course. And generally speaking, class notes is the single most important material to your preparation for the exams and you gaining knowledge. So make sure you have a few phone numbers, email addresses from your classmates. This becomes important. The outline is on Blackboard for those of you who haven't accessed it yet, because a few people came up to me this morning asking me about it. Okay? So all the information is there. So as far as the subject itself, we talked about the history of income tax. We talked about the purposes of taxation. It's really ways for governments of different levels, whether it's federal, state, local, to raise revenues to cover its expenses. That's really the primary purpose of the income tax. But of course, income tax is used for many other purposes, such as encourage, for example, or discourage certain types of behavior. You know, this is where a cigarette tax comes in, maybe mortgage interest deductions, charitable contribution to encourage people to, deduction to encourage people to contribute to charity, and so on and so forth. We covered, well, the mic is moving with me. Oh, you guys cannot hear me? Well, this doesn't work anyway. How about this? Is this better? A little better? Okay. Otherwise, I'll have to clip it on my nose. So, and this is on max already. Okay, so we talked about chapter 1. I said you don't really have to read it. You could just use my notes, but we discussed also the way government runs the tax system, and while the Congress ultimately is the authority in terms of tax law, that's one thing we realized very quickly. We're here to study law, right? Tax law. It appointed the Department of Treasury to administer its monetary policy, and in turn, the Department of Treasury created Internal Revenue Service, IRS. Okay, and this is the entity that enforces the laws, essentially. And the way they enforce the laws is through many ways, one of which is audit. They make sure that you do what you're supposed to do by checking on you. But of course, they cannot check every person. So they are being creative in that way. And they enter everyone's tax return into their system, and the system analyzes it and identifies potential problems, red flags, which we talked about. Also, pure random selection is utilized. And of course, government heavily relies on the reports it receives from people like you. In fact, not only it relies, but it compensates people for reporting on others by giving them something along the lines of commissions on taxes collected. And those amounts could be really big, as we discussed last class. Some of the biggest reporters, as we said, are disgruntled employees. Excuse me. course, your neighbors and ex-friends, boyfriends, girlfriends, spouses are falling into some of the top categories in terms of informants. So once again, be nice to people. It really pays. Okay. And we made a few very important points for you to keep in mind. Very important points. First is that there are different types of taxes. We talked about different ways government tries to raise revenues, you know, starting with income tax, but there's also property tax, there's sales tax, there's inheritance tax, there's estate tax, there's gift tax, and all the other good stuff, right? And all these taxes, again, are collected by different levels of government, federal, state, local. So it's important to keep all these things in mind and in the same time understand our mission here in this class. And while I'll expose you to a lot of different things, at the end of the day, the course is about federal income tax, right, on individuals as opposed to some other entities. Excuse me. So keep that in mind. We also talked about statute of limitations, and this is the limit which is placed by laws on both sides, taxpayer and the government, in terms of how long each can go after the other. So the government, generally speaking, can go after you, audit your tax return. How long? 3 years, we said. 3 years as a general rule, 3 years from the time you filed your return or should have filed your return, whichever is later. Now, keep in mind that what this means, therefore, is that if you never filed your tax return, what does that mean? It means the statute of limitation never starts running. So that means government could go after you for whatever time, forever, because the time didn't start clicking yet. So I just want to make sure we're clear on that. Okay? Now, if you omit from your tax return more than 25% of gross income, and we went into the formula yesterday, which I'll take you through quickly today also, well, then the government gets double time, 6 years. And of course, as we said, if it's not innocent omission, but intentional misrepresentation, somebody lies in their return, commits fraud, tax fraud, well, that's serious stuff, because that's criminal offense. A lot of people don't realize it. It's a crime to lie when it comes to tax return. And a lot of people go to prison for it. And if you lie on your tax return, then there is no statute of limitations. Which kind of is, I think, very interesting, because if you kill somebody, is there a statute of limitations? There is. Okay? There's limited time how long the government could go after you, generally speaking. But if you commit tax fraud, they could go after you forever. Okay? Just something to think about. Now, at the same time, the other way is true too, as I said. You know, there's only so long you could call the government and say, hey, why would you call the government? First of all, you don't call, right? How do you communicate, generally speaking? By filing a tax return, right? And if you file your tax return, sometimes you may overpay. So you would communicate with the government, although you can call them, but that's kind of usually secondary steps if they become necessary. And if you have nothing else to do, because sometimes you can spend a few hours on the line waiting for somebody to answer. But you may want to contact them to get your own money back if you realize later that you paid more than you were supposed to, right? In other words, you're asking for a refund. And again, there's also a statute of limitation on that. Because you could ask for a refund, generally speaking, 3 years again after the time you file or should have filed taxes, whichever is later, or 2 years after you paid taxes, right? If you paid taxes later. And we said that generally speaking, government allows you extension of time to file your return, about 6 months. And the due date is April 15th generally, right? 15th day of 4th month of your taxable year if you decide to go outside your calendar year. But the government doesn't give you extension of time to pay taxes. So even if you don't know how much you owe, estimate. If you make a mistake, interest and penalties, meaning if you underpay. If you overpay, we said the government says thank you. You don't get interest back. So that brings an interesting point. Is it good at the end of the year to get a lot of big refund? Is it good or bad? Sometimes I have press contacting me about this question. Is it good or bad? Yeah, so the answer to this question is, it depends what perspective you're taking. But on the pure sense of it, I would agree with that. It's bad because basically you've been overpaying during the year, which means you've been giving to the government interest-free loans, right? So you could have kept this money somewhere in the bank, which pays you nothing these days, but presumably invest somewhere and get benefit from the money, right? So you, from the financial perspective, and even from narrow or certain point of financial perspective, it's a bad idea. But, you know, for some people, this is the only way to save money. You know, if they get something immediately, just go spend it. Some people rely on this money to have money for vacation. So this is kind of forced set aside. So is it good or bad? Well, at the end of the day, it depends, right? So anyway, just a side comment. I got a inquiry yesterday. U.S. World News Report was looking for an interview about items that you don't have to pay taxes on. You know, usually on television, radio these days, everybody's talking about, okay, this is taxable, this is deductible, this is tax. But what about you make money and you pay no taxes on? So I gave them some cool examples, which I'll teach you in this course, because there are some amazing opportunities to make hundreds of thousands of dollars, millions of dollars, and pay zero taxes. And I'm talking about, obviously, ways that are completely legal, not after which you go to prison, right? Because the key is not only to eat well, but also to sleep well, right? So we'll talk about it, but we got to get a little bit more sophistication. But even after last class that I taught you, one of the things that I gave them, I said there's a common mistake. People think if they receive a gift, they have to pay taxes. Why? For two reasons. Why? Because they think it's just taxable item. And second reason, because they heard something about gift taxes. Well, you guys already know that while there is such thing as gift taxes, first of all, if they are payable, who has to pay them? The person who makes a gift, right? Not you receiving it. And second of all, gifts are excluded from taxation. That's the item's exclusion item. So you could get $1 billion in gifts, and there's going to be zero federal income tax. And most of the people don't know about it. Can you imagine how many people would sleep better at night knowing that all these years when they didn't pay taxes on gifts, it's actually legal and okay? This could prevent heart attacks. Okay? So you guys are growing on the level of your sophistication, at least from tax perspective. I'm sure you're very sophisticated in all other ways. But tax is a major part of our lives, no matter where you look, what you do. Taxes are right there, with you, waiting for you, welcoming you with open arms. Or handcuffs, depending how you look at it. All right, so with that aside, the way government figures out what it is that we're going to tax, and the actual item that is being taxed, by the way, it's called tax base, if you'd like to write it down. Tax base. Very important. Why do you think that song was created? It's all about the base. Tax base. This is what we're taxing, okay? And what are we applying against it? Some percent. And that's what gets us tax revenue. Right? I already gave you last class my excuse for horrible handwriting, so you just have to get used to it. So now, if you were a politician, right, this is what you have to play with right here. For example, if you want to increase tax revenues, how can you possibly do it? You could increase percentage, or you could increase tax base. For example, we just talked about gifts. You could make them taxable. In fact, there's a lot of talk, and less nowadays, but there was a lot of talk some years ago about flat tax structure, where it's going to be same low rate or relatively low rate applied, right? And there were a few people running for president on this platform. Will simplify taxes. It's going to be one rate, low rate. 15% or 10% or whatever it is. Okay? Now a question for you, my friends. If you're going to lower the rate, average rate is being applied now, and you want to keep the same tax revenue because you got to run the government, what has to happen? Tax base has to go up. That's the only way, but nobody talks about it. But if you start digging in these flat tax proposals, all of a sudden you see, oh, gifts are taxable now. Money's got to come from somewhere. Presuming, again, we're keeping same tax revenue, unless, of course, we're just living on credit cards, as we've been living for a while, right? As long as China will continue to finance us. Yes, sir?
Actually, this is probably going to be really relevant to the next 9 months, because this tax cut is more of a official tax cut.
Every single time we have election period, somebody's talking about it. Because it's sexy. It sounds good. Flat tax. Nobody says, you know, I'm going to simplify things. We're going to tax you on things we're not taxing you before, or taxing you right now. Nobody talks about it. And what's even more interesting, when you look at these flat tax proposals, it's not quite flat, because there are all these exceptions once again. But everybody wants to simplify. In fact, maybe today we'll learn that almost every president came out with something along the lines of that ended up being called Tax Simplification Act of. Okay? Everybody wants to simplify, and every time this happens, everybody runs to me saying, oh, Professor Melnick, will there be jobs for us? Because they're simplifying. Maybe there's going to be less need for accountants, tax people. You know? And my answer is always the same. Rest assured. There has never, ever been the time when there was a Tax Simplification Act passed, after which things were simplified. In fact, each and every time the Tax Simplification Act was passed, things got much more complicated, as you will see today. I'll give you an example just for fun of it. Okay? So don't you worry. Any other questions? All right, so since we're in an election period, I thought this would be a worthwhile small conversation. Anyway, so going back to our tax formula, in order to get to our base, which in income tax is taxable income, this is our tax base. We got to get there. We're starting very broadly. Because if you read the tax code, it's income broadly conceived. In fact, if you ever have a doubt whether something is taxable or not, rest assured, it's taxable. Because the default is it's taxable. In fact, if you read the law, the way it's written is income from whatever source derived, whatever, is taxable, unless. You see this approach? They're saying everything is taxable unless we specifically say this particular item is not. What you'll find fascinating that when we come to talk about deductions expenses, the approach is going to be complete opposite. The law is going to read, what's deductible? Nothing. Nothing is deductible unless we specify it is. You'll get to appreciate it more as we get there. Anyway, so we start income broadly conceived, anything and everything you could possibly think for, including gifts, everything, gross receipts, except for two items we said, borrowed funds, and when you get your own money back. Then we get to gross income, then we take out exclusions, and these are the items of income the government made a decision not to tax, like gifts received, like inheritances. Again, we're talking about federal income tax. I'll just fly through it because we discussed it in detail last class. Then we get into deductions, above the line deductions, below the line deductions. I gave you examples of them last class. We discussed itemized deductions or standard deduction, whichever is greater. Remember that? So this is where I'd like to pick it up today. Okay, we talked about the fact that standard deduction is really a combination of two amounts, basic and additional, depending on your filing status, right? An additional given to those 65 or over or blind, and if you have both, you get double. Okay? So, any questions on my review before we start some good stuff today? Some more good stuff. Any more questions? Yes?
So basically the additional standard deduction is only about people over 65 or blind?
Correct. Only 65 or blind. Nobody else gets it. So the only way to get it is to wait. Anybody else? Oh, what was the question? If any, the additional amount is given only to those 65 or over or blind, or anybody else? And my answer was, just like I said before, it's only to those 65 or over or blind. Okay, any other questions? Yes? There's a lot of you here, so if you raise your hand, it may be blending in with somebody, so just like go like this.
You mentioned that when receiving the gift is not taxable, so we should do
Yeah, so the question is, when we get a gift, I said it's not taxable, do we have to have a proof? Well, the answer is, the real answer is we're going to get there. This is like a broad painting, as we discussed last class. So we're going to zoom in on many of these items, and gift is going to be one of them. And we're going to talk about what is really a gift. okay, in the first place. For now, we're just doing this pretend game that we understand everything, okay? I'm just giving you a big picture items, but we'll talk about it. It's a very good question because you're right. You could call a gift whatever you want. It doesn't mean you just don't pay taxes. Oh, my boss, you know, December 31st just gave me a gift of $5,000 because, you know, he didn't have to. He just said, you know, I did a good job, but that was really a gift, right? Was that a gift? One more time. Oh, yes, thank you. After last class, I had a few students come up to me immediately and then one or two later asking me personal questions. So I asked them to remind me, I asked somebody else to remind me this class to talk about it. So I'm here to teach you stuff, but I cannot give you advice on your personal situations or departmental policy. Okay, so I just want to make sure it's clear. Having said that, I'll be delighted to point you in the right direction. So if anything happens, and we'll talk about a lot of things in this class, not just income tax, but things that have to do with other areas of law. You know, I'll be thrilled. Sometimes I get speakers here that kind of cover certain topics. But in any case, I will be thrilled to point you in the right direction or to the right professional. But you know, one thing you don't get when you sign up for my class is personal attorney or tax advisor. So, and that kind of would go against the policies of the department, okay? So I just want to make sure that's clear. General question that relates to what we discuss in class, delightfully. Other stuff cannot. Hope you understand. Okay? All right. Thank you for reminding me. Okay. So, so we're moving forward. Since there are no more questions, let's continue, pick up on the area of standard deductions, okay? So the rule that I gave you is applicable to both types of taxpayers, meaning those married, not married, or different categories. We'll study filing status. Don't worry about this. And again, somebody who is blind or 65 or over, we have certain rules. There are certain types of taxpayers that the government, I don't want to say doesn't like, but treats differently for maybe valid purposes. Okay? So, who are these taxpayers? Well, first of all, people who are married, not that they don't like married people, well, they really don't like married who file separate returns. What does that mean? We didn't even study that yet in detail, but you could imagine, right? You're a married person, you make some money, your spouse makes some money, you take a piece of paper and you put all your stuff in one piece of paper, right? One tax return, you submit it to the government gets one tax return, things are relatively easy. It gets tricky when people are married, but they say, you know, honey, let's just keep things separately. So you file your stuff on your piece of paper, tax return, I'll file my stuff on my tax return, let's file them separately. So now government gets double amount of work, two separate returns to review. First of all, why would somebody do that? Why would you, a person who's happily married, do anything separately from your spouse, like filing tax return? Yeah, so very good. So, for example, we studied last class, in general terms, don't get scared. For example, medical expenses, right? Well, in order to get deduction for medical expenses, you got to be really sick, but sick relative to your income, right? So if your adjusted gross income is high, the floor, remember 7.5%, 10% of adjusted gross income, that first amount, up to that amount of floor adjusted gross income, it doesn't get deducted. It's only amount that exceeds the floor that gets deduction, right? So if your spouse, for example, has medical expenses and no income at all, but you're making $1 million, there's going to be no deduction. So it may make sense to file separate returns and your spouse shows zero income if he or she made no money, because they weren't in this class. And they get all the medical expenses deducted, right? To the extent there is some income to offset against, or maybe other ways, or maybe they have a smaller income. Okay, everybody understand? Because the lower the income, the lower the floor is, right? So the more you could deduct. For example, I gave you an example. Let's say 10% threshold applies to you in medical expenses. If you incurred $15,000 in medical expenses and your adjusted gross income is $100,000, how much can you deduct, we said? $5,000, right? But what if your adjusted gross income now is $1 million? How much can you deduct? Nothing, right? So it may make sense to split so you could deduct or deduct more. Yes?
You said if that spouse, he or she is very sick, but she's no income, how she can be deducted no income?
Well, so if there is no income at all, maybe there are some carry forwards from last year of the income items. Maybe the person gets some passive income, not actively working, but there is some interest on bonds or rental income. But you're absolutely correct. Now, even, by the way, there are some tax credits we may study that even if there is no income, you may get some money from the government as well. So we'll study that. But the general rule is, yeah, if there is no income and there's no benefit, then there may not be benefit. That's why I said later, maybe spouse made just less income. Maybe spouse is making $10,000, not $200,000, okay? So you get the general point, yes?
Can you change your filing status each year, like whenever you want?
Well, we'll talk about filing statuses, hopefully maybe today. As long as you satisfy requirements for filing status, you may be able to change it, yes. Because to be, it's not like, okay, that's it. I want to be this. Okay, it's not like dating, you know. I'm dating, tomorrow I'm not dating. I'm single, or whatever. All right, so that's separate. That's a different story. All right, any other questions on that? Yes?
I want to know, Nick, the standard deduction, as you mentioned, Congress passed this standard deduction, but he said there is like no guarantee will continue to do so. What is the big reason Congress passed the standard deduction?
I have to repeat your question. If you could, a little bit louder. You're all the way at the end. Could you just repeat it louder? Because you're all the way at the end.
Okay. Does tax rule mention standard deduction passed by the Congress?
Yes.
And he said like it's not guaranteed to continue to do so. What is the big reason Congress?
Oh, you're saying why there is no guarantee that standard deduction may be around? Well, anybody wants to guess? The question is, it was written that the standard deduction may not be around and it may be eliminated by the government. What could be the possible reason for that? Yeah, maybe, you know, as economy gets worse, maybe the government needs to raise more money and they're going to pull back on benefits. One of the benefits is standard deduction. Unlikely, but nevertheless. Okay? All right, so any other reason why somebody would be married but want to file a separate return?
Maybe one spouse has higher tax liability that other spouse doesn't want to take.
Maybe one spouse has higher tax liability. Oh, then the other spouse would want to be responsible for? Is that what it is? Oh, that's a good point. And that brings me to the next point. When you file your joint return, as we'll study today, both spouses have to sign it. And once you sign it, there is such thing called joint and several liability. You know what that means? It means you are responsible for everything in the tax return, including the liability, the amounts due. So if your spouse doesn't pay taxes, guess who's responsible now? You are.
I had a situation when I got married and he had a huge debt. He owed to IRS about $140,000 because he didn't pay it for several years. They applied a lot of fees on top. And then we get married and then we do the joint return. And I didn't even get my portion because everything went towards like you know, his whatever he owes. And after that, like after a couple of years, I just started to do it separately.
That's right. Yeah, for those of you who didn't hear it, you know, you get married, and as a wedding present, you get a letter from the IRS that, hey, now you're going to be responsible for your spouse's tax obligations. Which is another reason why I told you last class, those of you who didn't get married yet, wait, you're going to learn so many reasons not to get married. And then you'll learn so many reasons to get married. And only then you'll be in a better position to decide, should you marry that person? For now, just tell them to wait.
Can you sign a pre-nuptials to protect yourself?
You could sign an agreement, but your agreement is between you and your spouse, so you could later sue them. But when it comes to the government, once you file joint return and you sign information in the return, you're responsible to the government. You could hold your spouse responsible later, but it's not going to help you with the government necessarily. So it's the same thing with tax preparers. Usually I get a question, what if my tax preparer made a mistake? Can I sue them? Absolutely. But it has nothing to do with the government. The government is going to hold you responsible. It's your tax return.
So you solve the problem with the government and then you tell your spouse to respond to you.
Yeah, you solve your problem with the government and you tell your spouse, get out. Or hold me harmless. That's the expression. In other words, reimburse me for all my losses. Absolutely.
Can you force that?
Yeah, absolutely. If there was an agreement, absolutely.
Force to solve it?
Absolutely. Which brings me to the next point.
I just had a point that you said before, as an example, for files separate from your joint income. If the income is over a certain tax bracket, but you submit it separately, you'll fall at a lower bracket.
Very good. Very good. Another example, you may want to file separately because overall you'll pay less taxes because the rate will be smaller. I may end up showing you some examples of that. But relating to the point that we just discussed, what if your spouse commits tax fraud and doesn't show the whole income or shows bogus expenses, and then you sign the return, joint return? Guess who's responsible for fraud now? You are. Okay? So a lot of people say, honey, I love you. But you keep your stuff separate from me. Okay? I don't want to see it. I don't want to hear it. I'm going to file my own tax return. Now, I see already some depressed faces in the room. So those of you who are married with depressed faces who signed the tax return, I just want to say something to you. There is such thing called innocent spouse provision, which means you could go to the IRS and say, I did not know, I am innocent. It's all she who did it. He, I'm sorry. Okay? Now, there's an exception rule, so if you're innocent, they'll let you out the hook. But you really have to be innocent. It cannot be what's known as willful blindness. Like, okay, don't show me, I don't want to know, where do I sign? I don't want to know. Okay, where's my Mercedes? You showed $30,000 gross income for the year? All right, it cannot be willful ignorance. It's got to be real honest lack of knowledge. Yeah, it's usually from year to year you get to choose your filing status as a general rule. Okay? All right. There was no example. It was just general statement that it's possible also when you file separate returns to end up paying less taxes. And I said we may get to that situation when we discuss tax rates. Okay. So with that in mind, that's married filing separately status. And we discussed why people sometimes would do it. Okay? Now, from the government's perspective, they have a rule. And the rule says, and this is something you may want to write down, if one spouse itemizes, and this is when it comes to married filing separately, right? When one spouse itemizes, takes itemized deductions, right? The other spouse must also itemize. Okay? You got it? So if one spouse itemizes, the other one cannot take standard deduction, in other words, right? Must itemize. And my question to you is, why? Why is there such a rule? Can anybody rationalize it?
Because it helps lower, like if one spouse suffers a lot of like itemized, like has a lot of deductions that can be itemized, while other spouse doesn't, like it could be a bit manipulated, like tax plan, and if other spouse can take a standard deduction, the government will lose a lot of money.
Government could lose a lot of money if one takes standard deduction and the other one itemized. Could be. But you're getting close. And what's wrong with one taking standard deduction and the other taking itemized anyway? Because when you go back to our formula, what does the law allow you? The greater of itemized or standard. Not both, the greater of. Honey, I have an idea. I have $20,000 we have in mortgage debt. We have $15,000 in standard deduction. How about we file separately? I get mortgage deduction, you get standard deduction. Cannot do it. Cannot have both. We told you it's either this or that. Okay? Very important. Well, if they file joint return, it's $120,000 in total return. If they separate, then it depends who paid for it. If they jointly paid for it, they split it equally, or depending who made what contribution toward it.
So even they file it separately, they still cannot take one take itemized, the other one take standard.
Cannot. That's what the law that we just learned says. You get either itemized or standard, cannot both. So if one spouse itemizes, the other spouse must itemize, we said. Otherwise, you're double dipping, right? All right. Another category of taxpayers we should know a little bit about is the category of dependents. Okay? We'll study who dependents are, what makes a person a dependent in a few moments. But for now, I just want to tell you that, well, you could guess probably, why would the government take away some benefits from dependents? Like give them maybe smaller standard deduction amounts. Because there's somebody already who's supporting them, who's helping them, and maybe those people get some benefits and so on and so forth. So that's another special category of taxpayers. And for this category of taxpayers, what I want you to know is when we figure out their standard deduction amount, we'll look at basic amount. And these amounts, okay, basic amounts, those who are dependents don't get. We have a separate formula for those people. Anybody remembers what the formula is?
I think it's 30 people whatever income they get, but it cannot be over 63%.
All right, so very good, thank you. So the rule is dependents' basic amount of standard deduction. I'm stressing basic because they still get additional amounts if they're blind or over 65. So the basic amount is calculated as the greater of two amounts. Please write it down. The greater of two amounts. The greater of two amounts. $1,050. $1,050 or $350 plus earned income. $1,050 or earned income plus $350. Whichever is greater. But the result could never be greater than what we give to everybody else, which is your basic amount. So this becomes a ceiling. In other words, we're trying to pull back benefits from these people, not to give them more than everybody else has. Does that make sense? That's a bit of logic behind it. So for example, if somebody is a dependent and they made $1,000 selling ice cream, what's their basic amount of standard deduction? So whatever the amount is, can somebody walk me through how we calculate it? So it's 1,000 plus 350 gets you 1,350, and that's greater than 1,050, right? So you get the bigger one. Very good. What if you made $200 selling ice cream? What's your basic amount? $1,050, right? Because it's bigger than 200 plus 350. 1,050, not 1,500, 1,050. Okay? Of course, if you're dependent and blind selling ice cream, well, you would taste it first, and then you get additional amount, right? What if you are so successful selling ice cream that you actually sold and made $10,000? What's your basic amount of standard deduction? Answer? Answer, it depends. It depends what filing status you're in, right? So presumably you're single, it's $6,300 for 2015. Any questions on this? Yes? Non-resident alien. We have an immigration class right after this class where we'll discuss it. But it's somebody who does not reside in the United States as a general proposition. But we may get to these conversations later on. Yes?
I think I read in the book something about a married person being able to be claimed as a dependent. So can you clarify that?
I can't, because we will discuss what it means in a few minutes. That's a whole topic of dependency. Okay? Who can be claimed dependent and all that stuff. But so far, calculation of amounts, I think it's pretty straightforward, right? Okay. So this is what I wanted to talk to you about. There are other exceptions, but these are the two main ones I wanted you to know for now about standard deductions. So once you go back to the formula, you pick the greater of itemized, and again, we'll study in more detail the specific itemized deduction. We'll come back to standard deductions. Then you get to the area called personal and dependency exemption. And it's another amount, fixed amount, the government gives to each person. Okay? For example, in 2015, happens to be $4,000. Okay? Personal dependency exemption. So who gets this amount? 4,000, it's a big amount, right? Because that, again, further decreases your base, right? So it's good stuff. Who gets it? You get it as a taxpayer as a general rule. So you get 4,000 for yourself. The way I would think about it, my suggestion, think about it like you're walking around and there's 4,000 above your head. Oh, you'll see how handy this example is going to get in a few moments. But just think, you know, like instead of saint, this thing, it's $4,000. Okay?
So you get 4,000 on the personal exemption and then 4,000 for an age dependent.
I love when you guys trying to push me further. Okay, so you get 4,000 for yourself. That's clear, right? Another 4,000 you get for your spouse. For those of you who are wondering about some benefits of getting married. Okay, so if you're married, now you have 4,000 for yourself and 4,000 for your spouse. Total already $8,000 deduction. You could already make $8,000 and pay no taxes, because $8,000 will wipe it out.
It's not like they are considered one person. They just do
Now maybe under some other perspective, you become one. But for tax purposes, we keep you separate. So you get 4 and your spouse gets 4. But yeah, you become like a unity. But still with double tax benefits. Okay? Now, you could get it for your spouse, presuming what? Going back to the question. Presuming your spouse is not a dependent of somebody else, right? So you could get your spouse's $4,000 if you guys file a joint return, first of all. It has to be joint return on one piece of paper. Okay? Because if you're filing separate returns, then where your spouse's $4,000 is going to go? To his or her own return, right? So you can't get it, generally. Okay? So this is very important. But here's an exception I'd like you to learn. So if you're married, even though you file a separate return, meaning your spouse files separately, you can still get your spouse's $4,000 on your own return if you satisfy 2 requirements for our purposes. Number 1, your spouse has no gross income. Please write it down. And number 2, your spouse is not a dependent of somebody else, like we already said. So generally, to get your spouse's exemption on your return, you have to file a joint return. Okay? One more time. Generally, to get your spouse's $4,000 exemption, you have to file a joint return. But even if you file separate returns, if you show that you satisfy the following requirements, number 1, that your spouse has no gross income, and if you wonder why is that helpful, well, because if there is no gross income, even if there's a mistake and spouse also took another $4,000 on his or her own return, there's going to be no benefit. There's nothing to offset. That's just a little bit of policy behind it, but it doesn't matter. As long as you remember that as long as your spouse has no gross income and not a dependent of anybody else, then you could claim your spouse's $4,000 on your own tax return. Why is that again? Because if you claim somebody as dependent, what do you get for it? You get their exemption, $4,000. Okay? So if your spouse is already dependent of somebody else, hopefully they're her parents or his parents, not some other boyfriend or girlfriend, then that person already took away that $4,000. It's gone. It's like that Harry Potter game, right? They were like grabbing these things, whatever, flying around. So it's gone. You can't get it anymore, right? So that's why the rule says, as long as they're not dependent on anybody else. Why do we care about that? Because somebody already takes that $4,000. And there's only one $4,000 per person. Once somebody grabs it, it's gone. It's not like you could have her $4,000 and I could have his $4,000. No. So again, you could get your spouse's $4,000 on your return, even though separate return is filed, as long as your spouse has no gross income, minimizes the risk of double dipping, and as long as your spouse is not a dependent of somebody else. Is that clear? Okay, I want to go back to questions. You had a question before.
Yeah, so for the joint return, if the husband and the wife, they both come to the spouse exemption $4,000?
Yeah, if joint return, then you get $4,000 for yourself and $4,000 for your spouse as a general rule.
Yeah, and also my spouse is willing to apply for her income. So that will be, so he also get $8,000 deduction?
No. You don't get $16,000 between two of you. Again, there's only one $4,000 each person has, not 8. So once it's used somewhere, it's gone. It cannot be used anywhere else. Okay? That's why I think this example is very handy. Does it? Does it help you? It helps me. Can the wife claim her husband as a dependent? Well, yeah, that's what I said. You as a taxpayer, whether you're husband or wife, could claim your spouse $4,000 on your return. It's not quite a dependent. You know, you don't usually claim your spouse as dependent. You just get their exemption on your tax return. Because you don't have to, because the reason I'm saying it, because to claim somebody is dependent, you have to prove they satisfy dependency requirements. With your spouse, the beautiful thing, you don't have to prove anything. You just got to show you guys are married. Then it kind of presumes a lot of things. So the answer is yes. Okay? So the third way to get another $4,000 deduction on your tax return is for each dependent that you have. Okay? Sometimes I get questions. Professor Melnick, what's the benefit of having kids? It's $4,000 extra deduction per year. What else is out there? In fact, speaking of tax planning, what is the best time to have a child born? December 31st. Because, you know, the child is born December 31st. You've spent not a penny the whole year. And then you get a $4,000 deduction. My first child, my first daughter, was born in January. What a disgrace. Horrible tax planning. I've gotten better with time, so my second was born in May. Okay, but the moment I realized I was really good as a tax planner is my third child was born in December. And of course, my arguments to my wife were always, honey, we need more deductions. It's very true, by the way. I'm not lying. 3 kids, January, May, December. Third one in December. Because, you know, with time you get better as a tax planner. Yes? If you have more than 12 kids, you're tax exempt to a certain extent. Yes, it's true. To which extent would you be exempt if you have 12 kids? Exactly. You take 10 kids times 4, it's 40, then 48 for 12. So you're exempt from taxation up to $48,000 minimum. But in the reality, there is no such thing. It's not really exemption. You just get deductions, you pay zero taxes. No such thing. Otherwise, I would have more arguments with my wife. Yes?
So married filing separately. Your husband files, your wife has to file. If you choose to file separately,
Oh, you don't care what your spouse does in reality when it comes to taxes. Sorry. So you file married filing separately. Your spouse does what he or she wants. Maybe they don't even file, but that could be a problem from tax perspective. We'll study. We're going to have a separate topic maybe today on who is required to file. Maybe your spouse is not even required to file. Not everybody has to file a tax return.
if she doesn't file, you can still claim.
Yeah, you can still get your spouse's exemption even if your spouse never files return. Yeah, very good question. Thank you. If you're head of foster home, are you thinking tax planning strategies right now? No. Owning a foster home business does, if you support a lot of people and you do have foster home and you have all these people in your household, yeah, there could be a situation where you could claim all of them as dependents. Absolutely. Yeah. Absolutely. Yes.
So does the $4,000 start diminishing as you have more and more dependents? No, after a certain amount, does it?
There is such thing called phase out of exemptions. So if you make more than a certain amount prescribed by law, and there's a conversation about it and text about it in your book, then they take out little by little. So it's possible that you could have a lot of kids and get zero exemption or close to it if you make a lot of money. Because the government says, look, exemption, we're here to help you so you pay less taxes. But if you make a lot of money, you don't need our help. Right? So that's why you stop at 3 and don't go to 12.
But how about if the children make more money than parents?
If children make more money than parents, we're going to talk about it soon. Because you're really asking, can you claim them still as dependent? And the answer is, it may be possible.
So still can get exemption?
It may be possible, in which case, yes, you will get exemption. And we'll get there in a few moments. So all these questions about dependence, and since we're in a customer-friendly environment, make me want to start discussion of dependency status right now. Okay? So what do you need to do to have a dependent? What do you need to prove to have a dependent? It's not enough to just have a child born. It's not that easy, so don't run away right now. There's a beautiful summary, actually, of this segment in your page 17 of the book. So this is, by the way, a perfect example of what we discussed before as far as Tax Simplification Act. It used to be that the only way to claim somebody as dependent, you had to satisfy qualifying relative requirements. But then the government says, oh, it's too complicated. It's just too complicated. You know, who's your dependent? Who's your child? Who's your qualifying child? All these definitions. Let's just come up with one definition. People, taxes are going to be simpler. Mark my word. And they came up with qualifying child. Way. The only thing is, they left also this one. So now we have two ways of qualifying somebody as dependent. Does that simplify things? Even more complicated. Absolutely. But, you know, it sounded good on campaign slogan. So this is a very good summary. I suggest you make a photocopy of it and post it on your wall by your bedside. So when you wake up, this is the first thing you look at. All right? So look, 1, 2, 3, 4, 5, 6 requirements on the qualifying child category. All right? You need to satisfy all 6. The reason why I'm saying it, because on exam people get excited. And they go through first one, okay, I satisfy the relationship test, done. No, it's not done. It's only one of many. You need all of them, okay? So let's start. Relationship test. In order to have somebody as your qualifying child, this person has to be your, I'm saying this person because I remember the case where somebody was trying to claim as dependent their dog. And the person said, I spend more money on my dog than you spend on your child. And it's interesting enough, but in supermarkets, it's the same aisle, you know, children food, dog food. I remember when it was first baby, at one time I just got confused between the two because it looked organic. My wife almost threw me out. All right. So it has to be a person who is your, today we're going to study who our relatives are, by the way. So who's your who? Child? What about grandchild? Yeah. How do we call people below you? Descendants. Exactly. Very good. your descendants, children, grandchildren, great-grandchildren, okay? Now, when I say child, by the way, I also mean foster child, adopted child, stepchild. Okay, it's all for tax purposes same as biological child. Okay. But not just your children, grandchildren. Who else is your qualifying child on definition? You guys remember from reading? Your brother and sister is your qualifying child. Speaking of Simplification Act, oh, it's so logical. Your brother is your child, the qualifying child. It's going to be so much easier to remember. Okay? So you qualify, so your siblings, right? Generally, they have to be younger, right? Unless they're disabled. Are your qualifying children also? For the purposes of claiming them as dependents. And their descendants, right? So your nieces and nephews, that's how we call your brother's child, right? Not spoiled person, but your niece and nephew, is your qualifying child also. You got it? So your descendants, your siblings, generally younger unless disabled, and their descendants, okay? Good. We're done. So it has to be one of these people in order to have a qualifying child. Next. Abode. What does that mean? It means your qualifying child has to live in the same household with you for a minimum of 6 months. Actually, it's more than 6 months, okay? Technically speaking. For more than 6 months during the year.
So going back to your previous example about if your child is born late in the year, like in December, so
that's okay because they were born that year, so that satisfies. Yeah, no problem. If they were born before but they were somewhere away. And by the way, abode test is also satisfied if you have these excused absences, like college, full-time student, or in the hospital, or, I don't know, in the army, right? I think prison will qualify too. Yes? Oh boy, here we go. You're filing taxes while your girlfriend is pregnant. You have much bigger issues than taxes at that point. You cannot claim that child on your tax return, even though you're supporting that girlfriend. We need to wait for the child to be born. And you cannot do things to cause early. Okay? Come on, honey, the baby has to be born before year end. Or it's going to cost us. Okay? Any other questions? All right, so that's a abode test. Age. Under 19 or full-time student under 24, right? Under 19 or full-time student under 24. And when we say full-time student, full-time for the 5 months of the year, right? So if you just have one semester, spring semester, finish in May, you're okay. Next, support test. Do you have to support? Yes.
If they're older, if they have a disability, do they qualify?
Yeah. Yeah, we said your sibling either younger than you or disabled. Support test. Do you have to support your dependent? Isn't that what you would expect? The answer is no. Support test, in case of qualifying child, speaking again of Tax Simplification Act, doesn't mean you have to support them. It means the child or your qualifying child cannot be self-supporting. That's all it means. Somebody else could support them, as long as they're not self-supporting. In other words, they cannot cover majority of their own day-to-day living expenses. That's all the support test says. No self-support. It really should say no self-support, but that would be too simple. Okay? But I don't want you to feel bad that these things are confusing, okay? Who writes these laws? Who writes these laws? Congress? Do you think Congressman actually sits and writes them? Tax people write them for them. Why do you think tax people make it so confusing? Oh, poor thing. You find this tax code confusing? Come here. With your checkbook. All right? So this brings us to the next point. Joint return. And what it should really say is no joint return. Because to claim somebody as dependent, as a general rule, they cannot file a joint return. Okay? So it really should say no joint return. Okay? What it really means, no joint return. Okay? Why are we saying this? Well, because we're scared, right? Why are we scared? Because somebody files joint return with somebody, then what may happen there? Their spouse may claim their tax exemption, right? So we're saying no joint tax return. But there is an exception to this rule. Unless, so no joint return, no joint return, no joint return. Unless what? Number one, neither spouse was required to file a joint return. Excuse me, neither spouse was required to file a return. In this case, joint return is a true statement. And the only reason they filed joint return is to obtain a refund, which essentially says there was really no income, because we'll study who's required, who's not required to file joint return. So even if they file jointly and claim exemption, they're not going to get any benefit from it. That's really what it's saying in a way, but we'll get back to this. So the fifth requirement, which says joint return, really says your dependent cannot file joint return unless joint return was filed to obtain a refund and they were really not required to file joint return. Okay? Yes?
Claim your parents as dependents and they can file their...
Wait, do parents fall here? Can your parent be a qualifying child? I mean, I know it's crazy, but it's not that crazy. But the answer is you can claim your parents' dependents. We'll get there under this category. So let's just get there. So this, yes?
So basically, it's like your brother who's disabled is married. He cannot file a joint return
unless
it's to obtain a refund.
Yeah, your brother, whom you want to claim as dependent on the qualifying child, cannot file joint return with his wife unless they weren't required to file. The only reason they file return to get a refund from the government. Exactly. Perfect. Last test, ladies and gentlemen, citizenship or residency. In order to be able to claim someone as dependent, as a general rule, and again, it's a general review course, your dependent must be either citizen or resident of United States or our neighbors, Mexico or Canada. Okay? What? what's our other neighbor? Mexico, right? So spring break is coming up. A lot of people go to Cancun or other places of Mexico. Good place to go. You could give a lot of people advice there. You know, if you happen to develop some dependence while here, you could get exemption for them. Okay? Now, usually at this point I get questions. Professor, my uncle who came here illegally didn't get his green card, but we have immigration class after this class. That's where we discuss. So stick around for those who are interested. Okay, any other questions? What resident? That's a good question. That's also immigration class. But so generally, when we talk about the United States, that's the green card, right? So you got to have a green card. Yes.
What about the U.S. territories?
U.S. territories. That's fine too. But I have to tell you something. We have treaties with other countries. There are other exceptions to this. For those who are interested, you could talk to me afterwards. You could look at the book. But these are the general, as I said, general laws, general guidelines for this type of review and course that we selected to expose you to. Okay? So going back to the question you asked earlier, do you see anywhere here limit on how much money a dependent can make? No. So can your dependent make more than you do? Yeah. Can your dependent be a billionaire?
Yes. But then they will be self-sufficient.
Not necessarily. They could make $1 million and set them aside in the bank for savings, and somebody else is supporting their day-to-day living expenses. Right? Like your child who doesn't know how to talk or walk, but already starring in diaper commercial and making millions just because they could poop on the screen. And then you take all their money and put them in some 529 college plan or whatever and other forms of investment, but you spend your own money supporting them. They don't self-support. You could claim them as dependent.
So what's self-support mean? Let's say you have a child who is a student of the U.S. but he's living in Britain or somewhere. Can he still...
So if we said citizen or resident, right? So as long as your child is a citizen of the U.S., they could live in Guatemala or France, it doesn't matter. You could claim them, okay? I'm saying Guatemala. I remember when I was working in Big Four and one of my managers went to vacation in Guatemala, came back married. They still live happily ever after. So maybe that's a magic place. Not that I'm not happy. You know, my biggest fear is when I sit with my wife in the restaurant, and it happened already quite a few times. Students come up and say, Professor Melnick, how are you? Oh, this is your wife. We heard so much about you. And this is when I know I'm in trouble. Did I just see a hand somewhere? Yes. Yeah, if your child is a citizen, lives in a different country, that's okay. There are other exceptions for adopted kids from other countries, and so on and so forth. But yes, a child can live anywhere.
Residency. You never answered that.
I said green cards. As long as they have a green card, that's a legal resident. But generally, it's where you reside. Now, the question of legality is a separate question. Yes? Oh, well, it depends. Yeah, so it may, oh, good question. Thank you. What you're saying is, look, if your child lives somewhere in Guatemala, then how is this, it's good for citizenship or residency test, right? Because if they're a citizen, for example. But then aren't you violating a boat test? And my answer is possibly. Why? Why possibly? Maybe they're in Guatemala doing what? Stationed in the army or studying abroad, or another good excuse like prison, I don't know. Okay? All right, so moving forward. qualifying relative, because I see somebody's concerned about claiming their parents. So let's talk about qualifying relatives. So we're starting again with the basic question which everyone would expect, and that is, naturally, you would expect to support somebody, right? And this is where logic kicks in. Yeah, we said that. Children, descendants of your siblings, which is your niece or nephew, are your qualifying children as well. So going back now to qualifying relative, which is broader category, so you have to support them. What does support mean? How much, what is percentage of their living expenses, day-to-day expenses, that you have to cover to be able to say, what? More than half, right? Then you could say, I support you, right? If you provide more than half. And these are basically food, shelter, clothing, education, right? These types of expenses. Now, what if you don't provide more than half? Like going back to the question about parents, right? What if there are like, I don't know, 5 kids, and they're all fighting to support their parents because parents did a good job raising them. So each one contributes equally, 20%. Can anyone support? Well, you would look at it, not one person contributes more than half, so normally the answer would be no. The good news, government made an exception, right? Support group. And it says, in cases where the group itself contributes more than half. Now we're looking already at the group, right? Because if the group itself contributes less than half, then nobody supports the person. As long as the group supports more than half, then you could claim an exemption. The person, one person still. One person. We don't do it like in accounting world where we prorate and allocate. We keep things simple here. One person can claim. Which person? The person who contributes, who's a member of the group, right? Contributes more than 10%. It's got to be a meaningful amount. So it's really any member of the group who contributes more than 10% can claim exemption, right? Good time to write things down. So any member of the group who contributes more than 10% can claim an exemption. As long as all other members of the group, all other members of the group? No, not really all. As long as all other members of the group who also contribute more than 10% agree to it in writing. So any member of the group satisfies the support requirement who contributes more than 10%, as long as all other members of the group who contribute more than 10% agree to it in writing. In other words, other members have to, in writing, agree, okay, you're going to be claiming exemption. Why do we want them to agree to it and in writing? Yeah, so they can say, oh, I didn't know that, so I claimed also as an exemption. Right? So we need to, in writing. But remember, the group itself has to contribute more than half, and you still have to satisfy all the other requirements. This is just one requirement.
What happens if, the parents have like 10 children, so their children as a group support half, but none of the children themselves?
If every person contributes 10%, 10 kids, 10%, nobody's going to claim. So you're going to have to kill one of the kids. Yes? Oh, who calculates it? How do you know? That's a good question. What do you think, guys? Well, I think this leads us to a bigger question, and that is, who has to prove it? Let's say, right? If IRS audits. So by the way, when IRS checks your return, does IRS have to prove that that's not 11%? That's 9%. Or do you have to prove? Who has the burden of proof? Big lesson point. As a general rule, you, taxpayer, have the burden of proof. And the burden of proof simply means you're the one. If there is a litigation, let's say, right? Okay, let me give you a mini lesson on burden of proof. You come to court. This is a legal subject matter. Two parties come to court, opposing parties, IRS and taxpayer, you. Both sit down. The judge says, okay, there's a question whether it was 11% support contributed. The person who has to get up and start proving is the person who has the burden of proof. And it's taxpayer. So IRS could just sit and do nothing like this. Prove it. Okay? That's the burden of proof. If IRS claims fraud, which is criminal offense, for criminal matters, we're shifting the burden of proof to the government. So if it's criminal case, both parties come to court, you taxpayer sit down, go like this, and say, prove it. That's what criminals do, or at least accused criminals. Prove that I killed them. They don't have to do anything. Have you wondered, by the way, why in criminal cases, where by putting the burden of proof on the government, does it make it easier or more difficult for the government to put somebody to prison?
Easier.
More difficult, because the government now has to prove. And, by the way, the level of proof has to be very high too. Not just, well, you probably did it, so we'll put you to prison, right? Is that the burden of proof? Is that the level of proof? You probably did it. You likely did it. He might have done it. Is it, well, more likely than not he did it, no? What's the level of proof? You guys watch television? In criminal, beyond any reasonable doubt. The government has to prove their case beyond a reasonable doubt. In other words, cannot be reasonably doubted that the person maybe they didn't do it. Maybe the glove didn't fit. You know? Very difficult. Why do you think we do that? Why do you think we make it so difficult for the government to prove that somebody is a criminal? What? Because we don't want innocent people to go to jail. Right? So it's a decision, it's a choice we made as a society. We rather have criminals on the street than innocent people in prison. It's very true. Because by putting the burden so high in the government, it's going to be possible, and there's going to be cases where the government just cannot prove beyond reasonable doubt. Right? So some criminal is going to walk. But we're saying we're willing to pay that price. As long as, because if we make a lower threshold, right, then it's possible somebody who's truly innocent will end up in prison. So it's a choice we make. If you ever wondered. But in civil cases, when it comes to taxes, the burden's on you. Right? There's even saying you're presumed guilty. You prove your innocence. Right? In criminal cases, you're presumed innocent. Government has to prove you're guilty. In tax, prove it. You cannot prove? Okay? It's not as bad as it used to be. You know, they used to tie a person's, what is it, like stone to the neck, and if the person is thrown in the river, and if they come up, they're innocent. If they stay, that means they were guilty. It's not as bad. Okay? So anyway, where were we? So support test. So the burden, that was a long answer to your wonderful million-dollar question, which is very handy to this class because we're going to come back to that. I might as well teach you now. So you asking who's going to count? Whoever's claims. Whoever wants to claim a deduction, they have to be prepared to show they provided more than half support. How are you going to do this? I don't know. But anybody wants to guess? You look at all the expenses went into support of the person, you know, their rent, food expenses, and you show what you spend, your credit card bills, your receipts. And if you say, well, but I didn't save anything, I can't prove it. Well, that's your problem. You can't prove it, no deduction. That's the full answer to your question. Maybe fuller than expected, okay? All right, so that's support test. Next, relationship test. Do you guys know who your relatives are? You sure? I call this YMCA dance, part of our programming. Okay, I usually make people get up, but we have, school is recording this, so I'll let you sit today. Why don't you all put your pens down? We're going to have a mid-inning stretch. I'm serious, nobody's writing. I'm going to take away credits. Raise your hands like this. Put your hands in the air like you don't care. Now, how do we call people above you? Ancestors. These are who? Your parents, your grandparents, your great-grandparents, right? Who are these people? Just don't hit anybody in the face. Put your hands on the side. Your siblings, your brothers or sisters. We already know who these people are. Who are these people? Descendants. What about this? Aunts and uncles. Very good. Aunts and uncles. Nieces and nephews. Siblings, nieces and nephews. Okay? These people are looking outside like, what's happening in this class? Is this a business school? It's an alternative form of teaching. All right, so we got this. So now you see somebody walking on campus going like this. They're not nuts. They're just in my class. Okay, so let's write it down. So your relatives, for the purpose of qualifying relatives, are your ancestors. We'll get to your buddies, cousins. They'll get special treatment from us. Your descendants, your brothers and sisters, aunts and uncles, right? Now, what about cousins? Did I say anything about cousins? All right, so ladies and gentlemen, and I know this may be tough for you, but your cousins are not your relatives. So now you go home. And that family picture, you take a marker, black marker, and you go like this. And some of you are like, I always knew that. For tax purposes. Okay? One more time. Your cousins are not your relatives for tax purposes. I don't know why. Maybe we're all cousins somewhere along the line. What if they live with you? They're still not your relatives. They could be whatever. even more than that. But they're still not your relatives. Is that clear? Yes?
So if my cousin's living with me for more than 6 months,
I don't want to go there yet. Especially in some personal stories. Okay? Is that clear? Now, what about your in-laws? Mother, brother, sister-in-law, are they your relatives? Yeah. So when I say brother, sister, also in-law is also your relative. And here's another one. You ready? What happens if you get divorced? Your ex-in-laws, are they still your relatives? Oh, please meet my ex-mother-in-law. Are they still your relatives? Answer. Yes. Yeah, so when you go to that wedding, going back to that date that's coming up, before you say I do, look at all these people around you. They're going to be your relatives for the rest of your life. Even after you get divorced. Now, is that good or bad for you? Well, it depends. It's good for tax purposes because you could claim them as dependent if you happen to still support them after divorce. I don't know why you would ever do that. Of course, I would always support my in-laws. But if you happen to support them, you can still get a deduction because they're still your relatives. What about your ex-spouse? Honey, I have an idea. I figured out a way to deal with all our problems. We get divorced. And I'll still claim you as dependent. Can you do that? Yes. Answer. Depends. In the year of divorce, you cannot claim your ex-spouse as dependent. Yes, in the year of divorce.
Okay, what was the question?
I don't know. The question was, in the year of divorce, we could still claim our ex-parents-in-law as dependents. And I said, yes. But we cannot claim ex-spouse. And I said, yes. You're welcome. But after the year of divorce, you can claim your ex-spouse, all of them, as dependents, as long as you satisfy all other requirements, like support, like everything else we're going to go through.
So, if with those requirements, ex-spouse still can be your dependent?
Yeah, but not in the year of divorce. So you got to get divorced, wait for a year, or get divorced on December 31st. The next year, immediately, you'll be able to claim them as dependent. For the next year, not for this year. Year of divorce, for that year, you cannot claim your spouse as dependent if you got divorced.
Okay, divorce that year cannot be.
Cannot be. Next year can.
But the ex-parents always can.
Ex-in-laws always. And if you got married and divorced 10 times, all of them, all the ex-in-laws, you could always claim them as dependents. If you get married again and?
And the other, for example, is supposed to claim him as dependent. You have the right to claim as dependent again.
If you get married again,
For example, and he's my ex-husband now, and I claim as dependent.
yeah,
Again, and the other wife claims him as dependent. I have the right to claim him as dependent too.
oh. The question is, what if I get divorced and my ex-spouse gets remarried and's got now his own wife? Can I, as a first wife, claim him as a dependent, and can the current wife claim him as dependent at the same time? It's whoever grabs it first. In reality, two people cannot provide more than half of the support. Right? So it's only, even in theory, only one can provide more than half. Unless they are part of support group somehow, but then you still have to meet all the other requirements. So I don't want to make it too complicated for you guys for now. Okay. Now, as you notice, it says relationship, and now we know or member of the household. Aha. So, what does that mean? This is where your cousins come in. And your boyfriends. How about what? Friends? Sure. Friends, no problem. If your friend lives with you, that's it. As long as they live with you for the entire year. Yeah, for the entire year. Yeah, member of the household for the entire year. So your friend, your cousin, a stranger, postman, milkman.
Not only for 6 months, must be the entire year?
Correct. Then you could claim them as dependent, even though they're not your relatives.
I have a question. Going back to the ex-spouse, can you pay alimony and still claim not like dependent or both?
Yeah, you could claim your ex-spouse as dependent and pay them alimony. Okay? Yes?
So that means that if they are your relatives, they don't have to live with you?
Correct. If they are your relatives, they don't have to live with you. Very good observation. Because there is no abode test here. Right? So it's either relative or member of the household. Okay?
So for the member of household, those not your relative must live with you. If they are your relative, they can live anywhere.
Correct. If relatives can live anywhere. If not, relatives must live with you. That's what you just said. And I'm saying that's correct. You're welcome. Entire year. Yeah. Joint return test. Same thing. Citizenship, residency. Same thing. The only new thing is gross income. Gross income simply says that your dependent cannot make more than what? The exemption amount, whatever that amount for that year is. 2015 is $4,000. That's it. Cannot make more than $4,000. So going back to your question, so you ask, is it possible for dependent to be making more money than you do? And I said yes, if this dependent is your qualifying child. But if this dependent is not your qualifying child, but qualifying relative, then we're limiting how much they could be making.
So for child, they can make $1 million.
Child or brother or sister or niece or nephew or grandchild. They could be millionaires because these are all your qualifying children. But anybody, now is it possible to claim somebody is dependent who would fall in both categories? Yeah, like a child is your descendant. It's good here and here. Doesn't mean you get it twice? No. All right, I think it's a good time to take a break. That's right. Very good. Take a break, get some rest. I'll see you in a few. As I was lecturing you, I just checked my emails. I got an email from our marketing and communications department. One of the reporters in prominent outlets wanted to comment about the tax proposals that Sanders, Clinton, Cruz, Trump, Rubio are making. That's what we discussed today. So I told them I cannot write a long story, but I just quickly emailed them what I told you, that there's really never been a true proposal that is flat. Okay, so let's continue our journey. Which reminds me, I should collect some of your autographs. So where are we in this discussion? We talked about dependency exemption, right? And requirements that need to be satisfied in order to claim somebody as a dependent. To the extent possible, if we could just put assignments in one pile, I would appreciate it on a going forward basis, but I know it's the first time. So, I mean, nice colors. As I said, I'm pretty flexible, but, and I'm not requiring, PowerPoint, Excels, it's really not necessary to me. I want to make sure you understand material, but as long as there is no abuse, So, something starts looking like you just ripped it out of something. And if you're ripping it out, at least try to do it neatly. Okay. So at this point, we talked about the formula from the big picture perspective. We talked about forms of income, exclusions, deductions, different types, and then standard deduction, exemptions, and how to get those through dependency exemption. So let's continue, since we already touched on the topic of filing statuses. Let's just talk about it a little bit. So as you could see, there are 5 main statuses: single, married, filing jointly, surviving spouse, head of household, married, filing separately, right? So what does it mean to be able to file as single or married filing jointly? You got to satisfy the requirements placed on you, right? You can't just say, okay, I feel like filing, okay? And it's possible to qualify for more than one filing status, in which case you just pick the one that's better for you, okay? Now, when we talk about what's better for us, what's not better for us, that's kind of a loaded question, which we'll get to discuss soon, hopefully. But for now, let's just understand and hopefully appreciate the following statuses. So, to be single, number one, the term is, from legal perspective, is unmarried. Person has to be unmarried. It's like married, and then you hit the undo button, right? Unmarried, which means not legally married. Or, unmarried could also mean other things like separated under divorce decree. In other words, you are not divorced yet, but you're legally separated. You went to court and you got a separation decree from the court. You're separated, living separately, or in separate maintenance. Okay, each person maintains him or herself. When do we consider you to be married? Well, we'll look in the last day of taxable year. You could be single the whole year. And on December 31st, you get married, guess what? You're married for the whole year. Okay? If somebody dies during the year, we'll look at the day of death. Were they married or were they not married? That's what determines their filing status for the year. So we'll look at the last, as a general rule, we'll look at the last day of the year. Okay? We never said, by the way, people have to live together in order to file married filing jointly, right? Sometimes people stay together longer the less time they spend together, meaning stay together married. So, last day of taxable year, okay? And you get benefits because, again, married filing jointly, you could get, like we already discussed, 2 amounts of exemptions, large standard deduction, and from taxation perspective, if you look at tables, the higher rate start being applied at a later time, which we'll get to. So there are some benefits to it, okay? And you can get those benefits by waiting the whole year and then just getting married. Last day, yes? Yeah, so as I just said, you could be married but under separation degree, right? Unmarried, right? So legally separated but legally still married but under separation degree or separate maintenance. For tax purposes, you're single. The people who are not legally married but are married, so for tax purposes, they're single, although the question whether somebody's married or not is really a state law question. So there's such thing as common law marriage sometimes. In certain states, if you live together for a while, you consider to be married. Okay? Now, so we got single, we got married filing jointly, again, as we discussed, when you're married, file joint return. Surviving spouse. Interesting filing status. What requirements do you need to satisfy in order to be able to file as surviving spouse, which is a better way to file than single because, again, more benefits the government gives you, the tax bracket is higher, and so on and so forth. Initial. So, year 1, year 2, year 3, let's say, right? This is the year when spouse dies. Okay? So the government says the year that follows death or the year after, right? The year 2 or 3. You may be eligible for surviving spouse filing status. By the way, sometimes I get a question. Okay, we'll get to this question a little bit later. All right, so what requirements do you have to satisfy in order to be able to file as surviving spouse? Anybody brought their book with them? No? Yeah? Could you pass it forward, please? Oh, that's not the book. I'm talking about the book. That's not the book. It's too heavy, huh? All right, because few people, I brought the whole book last time, but a few people asked me to show it again. But it's in the bookstore. All right, so the requirement is you have to have a dependent child. And please underline, highlight, and put a star next to the word child. Not qualifying child, child. And again, when I say child, I mean stepchild, adopted child, foster child, but child, not your brother. Okay? Child. Who lives with you, lives in your household, who's your dependent. So you have to have a dependent child who lives in your household for the majority of the year. Okay? And if you are in this, you satisfy this requirement, you fall under surviving spouse filing status, which means what? If you look at it, it's as if you are married in a way, because surviving spouse, if you look, it gets the same amount of standard deduction, right? And tax bracket, the rates, as far as the first rate, higher rate applicable, much better than single. So it's a much better filing status to be in than single, or even married filing separately. But it's given to you only during the year 2 and or 3, as long as you satisfy the requirement, which is having dependent child who lives with you for more than a year, for the majority of the year. Now, very important point I want to bring to your attention. Because sometimes I get questions like, well, in the year that spouse dies, do you get that spouse's exemption? Or other things. So, anybody here likes magic? By show of hands? Okay, since majority didn't show hands, I'm not going to show any magic tricks right now. But I will say that magic happens in year 1, the year of death, for tax purposes. Why? We pretend the person is alive. And that's going to be the answer to all your questions. So whenever you're going to think like, oh my God, the person died, is there an exemption for this person? What kind of standard? The answer is going to be the same. You pretend the person is alive. So you get this person's exemption, you file, what kind of tax return do you file? What type of filing status are you in? Married, filing jointly. Because in the year of death, we pretend the person is alive. Technically, you got to get okay from executor of the estate, but usually the spouse is executor of the estate. So, okay? So magic happens, you pretend the person is alive. Now, magic ends after the year of death. Okay? So, after the year of death, you can still get some benefit if you fall, for example, on the surviving spouse status. Because if you're on surviving spouse, your filing status is surviving spouse, but the return you file, and you file everything of a joint return. Because it's the same standard deduction, same tax brackets, and everything is the same. So it's a big benefit. But it's only good for 2 years after the year of death. But there is no magic anymore, which means if you're a surviving spouse, do you get exemption for the person who died? No, the person is gone. That's it. So no magic. It's just that you file joint return and you follow everything that follows from it. Okay, any questions on this? Yes. So after 2 years, we don't know what's going to happen yet. We didn't get there yet. But for now, we know that during the year 2 and or 3, you could be in surviving spouse. Yes? If you don't qualify for surviving spouse, well, then you could be single or something else. We didn't cover all the other possible statuses yet. But then if you don't, one thing is clear. If you don't qualify for surviving spouse status, you don't qualify for surviving spouse status. What happens after that, we shall find out soon. Okay? Yes?
That dependent child must be children cannot be niece, nephew.
Correct. Has to be child, not brother or niece or nephew. Okay? Year 2 and or 3. That's it. That's it. While you're crying. Usually by year 4, people stop crying. If you get remarried during these years, you're no longer surviving spouse. Then you're married filing jointly or married filing separately. Because that's a good point. To be in surviving spouse, again, you're not married anymore. Your spouse died. So if your spouse dies this year, next year you get married, then I think it's reasonable to ask the question, why did your spouse die in the first place? It would be what?
No, I mean, so as she said, the person died this year and next year get married, so you married.
Yeah, married filing jointly. If person died last year, this year you get married. What if your person dies this year and you get remarried this year? Yes, that's exciting. That's exciting. That's soap opera. Then you're in real trouble. Why are you in trouble? I don't know.
No, I mean, just that's the question.
Yeah, it's okay. Yeah, you could do that.
So, not me.
You could actually have one party, 2 parties for one, you know? I mean, the funeral and the wedding, and, you know, you don't call caterers twice. What? We look at your moment on the last day of taxable year. Remember? What happens on the last day of taxable year? If you're married, last day taxable year, you're married. That's it. Doesn't matter how many spouses died this year. Okay? It's not like you marry, remarry, they die, and then you have a choice. I could pick any one of them. It's the last day of tax. Whoever you marry, that's who's considered to be your spouse. Okay? Alrighty then. So the next one is head of household. That's an interesting one. Again, better than single, better treatment. If you look at standard deduction amount, better than single, right? 9,100, 2014 versus 6,000, right? This is good stuff. So what requirements do you need to satisfy? Again, unmarried, right? You cannot be married and be head of household, as a general rule. So general rule, you have to be unmarried and maintain household for dependent whom? Relative. And maintain household for dependent relative. And please, again, underline, highlight the word relative. This relative means relative. Person must be related to you. And I would write it down. Why? Because I'm going to get billion questions. No matter what, no matter how. Professor, can your cousin be your dependent? Yes. If they live with you, they're qualifying. Aren't they qualifying relative? Yeah. So you could be a head of household? No. Why not? Because they're not related to you. So the confusion is between qualifying relative term and relative, right? Because you could claim somebody as a dependent on the qualifying relative, because on the qualifying relative we said it's either relative, related, or member of the household, which is where a cousin could come in. But to be a head of household, you have to have a dependent who's related to you, who's your relative. Watch, I'm still going to get a million questions on this. So I want to stress it one more time. Cousins are not your relatives. So they can be your dependent because they live with you, and thus qualifying relative under tax terminology. But they're not related to you. And therefore, they alone cannot make you head of household. Think about it. I want questions on this now. I even have a very sophisticated chart, visual. You want visual? You got it. Again, it's a very customer-friendly environment here. This is $1 million slide. To have a dependent, to claim somebody is dependent, qualifying child or qualifying relative, right? To be a qualifying relative, you could be either a relative, which is your YMCA dance we did today, or member of the household. To be head of household, only through these two routes. Not this. It's okay. Any questions? Yes. It's a dance. It's a very famous song. And you go, how do you go YMCA again? Anybody sings here? Why? No? So, it's a famous song, but this is what we did today. Ancestors, descendants, siblings, your relatives, whom we call relatives, but cousins, not your relatives. So this is where cousins are, and friends and relatives, friends, boyfriends who are not your friends. Okay? Any other questions? Okay. Please remember this. This is $1 million slide. Very sophisticated. All right, so this is, now, exception to head of household is for parents. Because we said dependent must live with you, right, to be a head of household? Your parents do not have to live with you. You could kick them out into nursing home as they get older. And you could still claim them as dependents. Same with grandparents. No. What about what? Parents? Well, if they're working, they may not qualify as dependents, remember. But they may. Because if they're working, remember, parents could only be your dependent on the qualifying relative, right? Because they're not your qualifying children. And the qualifying relative has a gross income test. They cannot make more than gross income, than exemption, which is $4,000 last year, right? So as long as they don't violate it, that could work. It's okay. You always have to show the proof if you're asked to do that. And the only position you could take on your tax return, meaning items put in the tax return, is if you have support for them. Otherwise, you could get in a lot of trouble. So that's a conversation about filing statuses, okay? So this murky picture gets a little bit clearer as we go through. Now, next interesting question is, and I promise to talk about it today, is, well, who's required to file? There was one question today. So why don't we talk about it? Who's required to file? What are the filing requirements? What is the function of? How does the government determine? Do you have to file taxes or not? Income? Even if you are like 1 month old? Remember that child in diapers making $1 million? Answer, you're right. We don't care about the age. Yes. Once you're 24, you can no longer be a dependent? Who said that? That's to be qualifying child. You have to be under 19 or full-time student under 24. Here, somebody could be 150 years old. Because there is no age test. Okay? That's where your parents come in and your grandparents come in. So, filing requirement, you're right, it's a function of your gross income. And I'll give you a simple rule. You guys like simple rules? I know you like simple rules. I'll give it to you, but not today. No, today too. So, a person must file, and I suggest you write it down. A person must file if gross income equals or exceeds. A person must file if their gross income equals or exceeds a sum of their standard deduction plus exemption. Okay, so GI, gross income, equals or exceeds standard deduction plus exemption, in which case, person has to file. Okay? Okay? Oh, you mean to repeat something before that? Person has to file if their gross income equals or exceeds the sum of standard deduction plus exemption. And when we calculate the amount of standard deduction as a general rule, we ignore blindness. Right? So we only, because remember, standard deduction is a function of two amounts. Remember that? It's basic and additional, right? Additional is to those who are 65 or over or blind, right? We ignore blindness. You could be blind, you don't get extra amount. But if you're 65 or 70, you do. So gross income equals or exceeds standard deduction plus extra amount if you're 65 or over, plus exemption. That's the general rule. You got it? Yeah, you don't get this amount for being blind for the purpose of determining whether you have to file or not. Additional amount. Because remember, this amount is given to those who are blind or 65 or over. Yeah. So in this case, you don't add that. Now, yeah, you have to know. Although so far we didn't say anything about dependence. We just said whether you're blind or 65 or over. It's a general rule applicable to everybody as a general rule. Gross income equals or exceeds standard deduction plus exemption. But you're right. And speaking of dependents, we'll get to them in a second. We already said that the government gives general rules, but it makes exceptions in certain cases. And we already identified two sets of taxpayers the government doesn't really like, if we could put it this way. I'm not saying they don't like them necessarily. So remember we talked about married filing separately, our buddies who just keep things separately? These guys have to file if their gross income equals or exceeds exemption. That's it. They lose, you could cross out standard deduction. Married filing separately must file if their gross income equals or exceeds exemption amount, their exemption amount. To everybody else, we gave standard deduction plus exemption. These guys, only exemption. In this case, if one person, $4,000. So if their gross income equals or exceeds $4,000, they must file. $4,050, they must file. You understand? Now, if you're looking for a way to remember, if you're looking for some tie-ins, I don't know. Remember I gave you a rule. If you are married filing separately, if one person is itemized, the other person must do what? Also itemize. What do they lose? They lose standard deduction. So here, they lost standard deduction. If you want to make some mental connections to make it easier to remember in the exam.
So if one spouse has to itemize and their deduction is greater than the exemption amount, it's not 300.
Wait. Greater than standard deduction.
Okay. Standard deduction 4,000.
No. Okay. Standard deduction is 4,000 is exemption. Standard deduction are these amounts. So married filing jointly, 2015 is $12,600.
My question was that if both spouses, if one spouse itemizes and the other has to itemize, but what if the second one that's forced to itemize made less than the standard deduction?
They still itemize. We don't care how much they're making at that point. If one spouse itemizes, the other must itemize, and we don't care about anything at that point. Simple. Okay?
Why is for the additional standard deduction, why is it only for blind?
What a good question. That's $1 million question. How come we're giving additional amount only to blind or 65 and over? Why not people who cannot hear? I don't know. How are the laws made in this country? Lobbying, right? I don't know, maybe these blind people came with stakes and I don't know, I'm kidding. Actually, you guys are going to explore this, some of you, towards the end of the course when we're going to do projects. It's tough to fill out return if you cannot see. But then you could make many other arguments. I think it's a valid question, by the way. It's a very, very valid question. Okay. Okay, putting aside all the inappropriate and bad jokes, which I strike. Now, let's talk about our other buddies, dependents, right? That was a question. What do dependents generally lose? Exemption, right? So, as a general rule, dependents must file if their gross income equals or exceeds what? Standard deduction. They lose exemption. That's a general rule. There are some exceptions to it. If you look actually in your book, on page 323, you get the full rule about filing requirements for dependents. 23, chapter 3, 23, page 23. Earn income only. Earn income only. And gross income that is more than the total of standard deduction, including additional deduction, for the year. So a few points here. Number one, when we say dependents have to file when their gross income equals standard deduction as a general rule, these guys get additional amount for blindness. Because remember, standard deduction is combination of what? Basic plus additional. Additional is given to those who are 65 or over or blind, remember? And or blind. So while everybody doesn't get additional amount for blindness in determining whether they have to file or not, dependents get additional amounts, number one, if they're blind. Number two, how do dependents calculate their standard deduction? Anybody remembers? Do they just go to the chart? Remember the government pulled it back? We said it's either $1,050 or earned income plus $350. So if you read these, dependents must file if they earn income only, and gross income is more than standard deduction. Well, if they have earned income only, what's their standard deduction? Earned income only. So again, it's either $350 plus earned income or $1,050, whichever is greater, right? But it cannot be more than what's given to everybody else. Unearned income only. So no earned income, only unearned income, and gross income of more than $1,050. Surprise! If there is no unearned income, what's dependent standard deduction? $10,050. That's there. So it's going to bring you back as a general rule to standard deduction. So you're going to look at what is the dependent standard deduction, and if the gross income more than that, they have to file. Okay. There are some exceptions which we'll get to later, but this is what I want you to know for now. Okay? So, these are filing consideration. Who has to file? When has to file? Now, we talked about head of households, right? What happens? You go away with your spouse, happily married. You go on vacation. You wake up in the morning. Look at this. You open your eyes, and guess what? Your spouse is gone. What is the first thing that comes to your mind? What is the first thing that comes to your mind? How am I going to file, right? Why? Because you're married, but to file joint return, your spouse has to be there to sign it, but the spouse is gone. So how do you file in this situation? Let's think about it. You're married, but the spouse is gone. In fact, there's a note on the pillow that says, "I'm gone." How are you going to file? Well, before we get into special ruling, how do you file? Can you file married filing jointly? No. Can you file single? No. So it's married filing separately, which is horrible. Government pulls a lot of benefits and other things that you'll learn as we go through. So you start crying even more now, right? And here a taxman comes in and says, "Don't you worry. We made a special exception for you. And that's called how? Abandoned spouse exception. So it's good news. Your life is going to get better. And before we even cover the requirements that need to be satisfied in order for you to be able to file as abandoned spouse, big picture I want you to understand first. And the big picture is what? If you satisfy requirements, you'll be able to file as head of household, which is better than single, better than married filing separately. It's head of household because you get more benefits. Head of household. Okay? So it's very important. There's a attendance sheet. Please pass it back. Yes? So the question is, what requirements do you have to satisfy in order to be abandoned spouse for tax purposes and file as a head of household? You ready? Number one, taxpayer cannot file joint return with the other spouse because there's nobody to sign it. They're gone. Okay? So if the spouse left a note, I'm gone, but when you file taxes, I'll come back to sign them. Well, then you're not in that status. Okay? Number two, taxpayer's spouse did not live in the same household for the last 6 months of taxable year. In other words, if you're going to get abandoned, you better get abandoned early in the year. It cannot be one of those situations. Honey, I have a question. Instead of us filing separately and being married filing separately, how about I abandon you? Just a few days before New Year. No. If you're going to abandon me, you better abandon me at least 6 months before year end. But I cannot be without you for such a long time. Well, then the whole tax strategy is out of the window. Okay? Plus, abandon has to be an abandonment. It cannot be just fraud type of setting where let's abandon each other. Okay? Then you got to get abandoned in prison. Number two, taxpayer must maintain household for dependent child once again. Okay? Taxpayer must maintain household, which really means pay more than half of the expenses, where dependent child lives. They have to live together, of course. Okay? So have to live together with dependent who is a child, and the spouse must maintain household. So you have to have a child. If you have a child and you get abandoned properly, not during the last 6 months of the year, because I was like, oh my God, not only she abandoned me, but also last month of the year. Who abandoned somebody like that? It's like double slap. Okay? Then, good news. Then you get up and say, oh my God, this is such a good news. I could still file as head of household. And you stop crying immediately. Okay? But you have to have a dependent child. Dependent cousin is not good enough here. Okay? Has to be a child. And also cannot be nephew, niece. Or grandparent. No. And not even grandfather. Child. Okay? All right. So this was a conversation, rather a lengthy one, and I purposely took it slowly because this is your first exposure to this wonderful, exciting, as you could already see, world of taxation. Okay, so I want to make sure we're going to pick up the pace as we go through the course, but for now, I want to make sure you're all comfortable. Okay, once the deadline for dropping the course passes, that's when it gets really miserable. Yes. Yes. Dependency requirements. So to have your child to be as dependent, your child could be dependent two ways. Qualifying child, so you just go through the same route. You go ahead. It's okay. The question is, I wonder how a husband is going to file if she files as abandoned spouse. Answer, we don't care what happens to him. I love your second question. Does he get hurt by the fact that she files as head of household? So, number one, how does he file? Let's talk about it. How does he file if he's the one abandoning? Same conversation. He's married, so it's either got to be married filing separately or possibly single if there is separate maintenance. But maybe in that same year, that spouse has a dependent child from the same or different marriage. Then could be still head of household, right? So there are a lot of possibilities here. But if she, using your example, files married filing separately and itemizes, he must itemize, cannot take standard deduction. So that's why maybe he could get hurt. And the question I usually get here, but how are you going to know how he or she files? Right? How are you going to know? And the government says, you know, what in this case? And I say, that's your problem. In other words, if you don't know, well then you can't take standard deduction. Then you got to itemize. Because before you take any position, you have to have support for it. If you cannot prove that the person takes standard deduction, well then you can't.
So could it possibly happen?
Yes.
I was going to say both spouses claim to be abandoned spouse.
Absolutely. Yeah. In fact, those of you who study law, there are some. It's been a while since my law school days, and I've never practiced in that area of family law. But you know, there's I think constructive abandonment or something like this, when you don't get certain type of treatment from your spouse. You could say, I've been abandoned way before that. As I said before, he even asked the question. Whenever you ask me a question, is it possible? The answer is probably yes. Everybody could claim whatever they want. The question is, at the end of the day, who's able to prove what? That's really the question.
I saw there's 3 different requirements that it doesn't mention you must be abandoned.
Where are you looking?
No, I mean the abandoned spouse must.
Oh, I mean, under abandoned spouse rule, there is no requirement to be abandoned.
Yeah.
But what is the title of the whole thing? It's just to say you're abandoned, it means nothing, right? So you got to show those elements they require.
Both parties can show, yes, we are not live for 6 months and we all have dependent child.
Yeah, and if you satisfy the requirements of the abandoned, then you could file as head of household. Because at the end of the day, think about it. All it does is just enables you to file as a head of household. So if you live separately, then technically, you know, you are unmarried, right? Already. So this just gives you, you have a child, so not just have a dependent, but be able to file a head of household. But you're right. I mean, the tax law doesn't get into arguments who abandoned whom and what you really abandoned. You know, they don't run into a hotel and say, you know, they don't send Inspector Clouseau, whatever. Okay? Yes? Redundant in this class? Are you kidding me?
So, Mary, he abandons her. She files as abandoned.
Why do we keep he abandoning her? Where do you guys get these things? It's always he who abandons. Okay, fine. He abandoned her.
She has no contact with him whatsoever. She files as head of household. He files as married, filing separately in items. She's still held.
She did not. Well, that's a good question. That's a very good question. So technically, that rule applies to married filing separately people, right? She doesn't file married filing separately, so it's a brand new game for her, because it's head of household.
So even though he itemizes it, does not affect her tax return.
Should not. Yeah, it's a good question. Very good question. You guys watch soap operas?
So he abandoned her. You said that it's possible that he files as single?
Yeah, if he files for separation, something along these lines. Yeah, because we said to be able to single, he could be married. Excuse me?
He could get separation without her?
He could file for, yeah, there are certain situations where you could get separated without even consent. Yeah. You guys, I see a lot of you interested in family law. These are beyond tax questions. I know, it's interesting. Okay. So, I'd like to introduce another $1 million topic that you're going to hear for the rest of your life in all the settings, but time flies when you're having fun. My goodness. So how about we end here then? Next class, I'm going to start, nobody moves, because I got to give you some homework to do. Oh no. Homework? In a business school? Are you kidding me? So next class, I'll start with capital gain topics, okay? A lot of conversation will be about it, always during presidential debates. And period. But having said that, for today, you submitted up to question 34, right?